So when you start to think about how does the cash value in life insurance work, think of it as something that's very familiar to you. If you're a realtor or a real estate investor, think of it a HELOC. If you're someone that has a credit card, uses a credit card on a daily basis, think of a credit card. When you're a business owner and you have a business line of credit, think of that. Lastly, one of the most profound characteristics about this line of credit versus others is it has compounding interest that you can't lose money in, which essentially means your line of credit will always continue to increase for the rest of your life. The worst thing that can happen is when you need access to capital and that capital disappears because it's exposed to something like the market. If the market goes down 50%, you now have 50% less money to be able to go use for other assets when all other assets are also on discount. If you think about it, the majority of the assets are correlated and work together. When the real estate market goes down, so is the stock market. When the stock market goes down, well, obviously the real estate market's down. And if that's the case, you want access to as much capital as possible. And if I have a vehicle that isn't exposed to the market and actually increases the same year all other asset classes go down, now that means I have access to more capital to be able to go leverage, to go use for other assets that are on discount at that moment. So again, when thinking about how cash value in life insurance works, just think of it like a line of credit.